Well, thank you for taking class 11, which is Executive Compensation Expanded. And today we're going to talk about executive benefits for key people and owners. And we're going to spend a lot of time on that, but I didn't want to start doing this class without talking about the other type of plans, what we would know as regulated plans or pension plans. And in that particular area, we're talking about the chart that you see above here, the 403, the 401k, the government 457, and that's a whole different subject. But those are what I would consider employee-driven plans. Many companies have a 401k or a profit sharing plan, and that's a whole class in and of itself. I didn't want to overlook it, but they do exist, and most companies do like to have those plans. But the plans I'm going to talk about today is an expansion of the earlier classes we had, which were about treating owners and high-level employees differently. Well, the first thing you need to know is that in executive compensation, the timeline is very important. For an example, if you're looking for current benefits, you're looking at things such as executive benefit bonus plans, 162, something called split dollar, where the corporation supports a benefit for an employee but is reimbursed, to another plan called split dollar, where the company is just sponsoring a benefit until the employee leaves, and it's used to keep them involved with the company. So maybe those are current benefits, but then you have deferred benefits where you have higher paid people that want benefits when they retire, and they're down the road a little bit, and they're highly compensated people. They want to defer income. They want some kind of guarantee on top of their pensions that there's more money if they stay. So we can combine those particular benefits and skew them the way we want to. But in the benefit area, if you really break it down, executive benefits are really what we call non-qualified benefits. They're benefits that are not for the rank and file. They're not for the full population. They're really designed to be for selected people. And the nice thing about it is you get to select as the owner who you want in the plan and who you don't. And the plan does not have to be, if you have one plan, you don't have to have everybody in that plan of your selected people. You can pick and choose. And we're going to go through that. So sometimes you got to look at a short-term benefit. Maybe you got to create a benefit over the next 5 or 10 years to keep someone there. That's very possible. Put some incentives of vesting benefits in there, a vesting schedule. There's long-term benefits. Maybe you want to create a key group. You don't want them to leave. You don't want your competition to get them. So you can create benefits that would be very hard to walk away from as far as going to the competition. Maybe you want a benefit that you have current taxation implications, such as deductions, or a way of supporting the taxation issue of an employee. Maybe you want to defer the tax till later. Now, some companies put in plans where they say, well, I don't mind paying for it, but at some point I want my money back, and that's called cost recovery. So let's take a look at where you are today. You'll see on the left-hand side, you've got elements of what the company is looking for. They're looking for current tax deductions, tax deferral accumulations. They want to select employees. They want maybe liquidity. Maybe they're concerned about outlay. On the right, you have the participant. The participant, by the way, could be just you, the owner of the company. Could be your family member. Could be your son-in-law. Whatever it might be. But so for an example, let's say in a plan that we were developing, we wanted to make sure there was liquidity involved for both sides. Maybe we were sensitive to the current cash outlay and we need flexibility. Maybe we only want to select a few people, maybe one, maybe three, who knows, but they're selected people. And maybe we want, as a company, a full tax deduction. Well, we can design these things on the left-hand side, and we can also design it on the right-hand side. So as I go through this, you'll see that in this grid, we're going to highlight the benefits under each generic executive compensation. So for an example, if I go to executive bonus 162 using a high cash value life insurance policy, which is very competitive when you compare it to other alternatives, you'll notice you have current tax deductions, you have cash flexibility, you could select, meaning as the employer can select the employee, and you could have flexible contributions. For the employee, there could be a current tax deduction, income tax, and there could be deferrals, and you could have tax-free distributions. And on the right-hand side, having income tax-free death benefits, accumulation of wealth, and liquidity as family bank might be important. And also on some of these plans, you could have critical illness. Well, on a salary continuation plan, you might see a little bit of a difference. You might see the company is saying, we'll take a future tax deduction and we'll get our money back, but it won't be tax deductible today. But we'll accrue our benefits, and then potentially when that employee retires, we'll pay an income, have cost recovery, they'll be tax advantaged. Now, split dollar economic benefit is basically a plan where the company is saying, I want to support the plan, but I want my money back, and between now and the future, you'll get other benefits, such as income tax-free death benefit. A typical example would be someone who needs a lot of life insurance, and the employer is willing to pay for it, but they would get their money back. And basically a benefit that the employee probably could not afford to do. Now, split dollar loan, the split dollar loan arrangement is very flexible. It can be designed like a 162 bonus plan where both parties have very nice requirements and they have a lot of flexibility. I can give you an example. When we look at certain plans that we designed, we can do many things. In this particular example, I'm going to show you that in this case, we have three arrangements. We could have a bonus plan with loans for the taxes and the imputed income, and the corporation pays the premium, but they deduct it. And the loans have a tax cost and interest cost to it. But the employee ends up with very low cost benefit. I can have an arrangement where the corporation pays and owns the cash value up to the deposits. The employee will pay a small interest rate or the tax on that, which should be substantially lower than any imputed income on the benefit. So for an example, if I have $1 million death benefit and the federal adjusted rate was $3,000, the employees in a 30% tax bracket is only going to pay $900 for such a big benefit. Or I could actually have an arrangement where the corporation sponsors the premium, pays it, owns the cash value up to their contributions. But then down the road in the future, the corporation can hand over the policy and the employee could pull out tax-free the money to pay the company back on a cost recoverable basis. So you see, there are a lot of different ways of doing it. And I'll give you an example. This is called the CEP, the Corporate Executive Equity Plan, which is really a skewing of a split dollar and bonus 162 plan. And in this particular case, we had the HX company contribute $25,000 to an insurance plan. That net cost to that company is $17,000 a year. They deduct it. Ajax is not paying more than the gross premium, and so what's happening is that the employee takes on the cost of the taxes, but in this particular case, we had the company support a loan to pay those taxes. When the time comes where Mr. Small is going to withdraw, he's going to take a full withdrawal tax-free to pay back the loan that Ajax paid into the plan. Ajax can forgive the loan and have it imputed in Mr. Small's income, and in which case, in a 30% tax bracket on $314,000, Mr. Small would withdraw $94,000 of tax-free dollars. In that particular case, number 3, we could do the same thing as number 2, but the difference is not only are we paying the company back, but Mr. Small is going to take a payout for 18 years of $67,500 tax-free, which is the equivalent of $96,429. And in number 3, it didn't cost him a dime. That payout is worth $1.2 million. So if I look at it and I break this type of benefit that we put together for Mr. Small, you could see that on the employer side, they put in $25,000 a year. It cost them $17,000. So the total premium to age 65, 66 was $675,000. They deducted that total premium as compensation. It would cost them $472,000. So the total loans to pay the taxes and the interest on the taxes was $202,000 and $120,000 for a total of $340,000. If the loan is given, they deduct it, and it costs them $220,000 to get the benefit to the employee. The employee, on the other hand, averaged $4,000 of interest cost on the loans that paid his taxes and the interest. The loan is paid off at retirement, $314,000. In this case, Mr. Small pulled out $314,000 tax-free dollars, paid the company back for what they paid on an after-tax basis. At retirement, after that's all done, Mr. Small took out $94,000 to pay the loan. His tax cost was forgiven. That was one way of doing it. There was no cost to him at all because the money he used to pay either the tax or the loan back came from the policy, which was ceded by the company. The cash values at 65 or 66 would have been $793,000. In other words, Mr. Small paid nothing out of his pocket. Everything was funded for him, and he walks away with $793,000. His death benefit is $2 million. But he also could turn this into a tax-free retirement income by taking $67,000 out, which is the equivalent of $96,000, and that would be for 18 years, or a total of $1.2 million of tax-free dollars. And again, this is all subjected to current dividend scales and that type of stuff with the assumptions that we made. So when you do all of this, you have to consider a number of things. Your business situation, you got to consider your personal situation. You have to identify some of the key issues that you really want in the planning, which we help you with. And we obviously review and discuss all this. But I would tell you that if you are a business owner and your business is doing pretty well, you're doing yourself a disservice by not looking into executive compensation programs, which you can use for you and your family. Use your corporate dollar cash flow to create wealth outside of your business. Because the truth is that about 78% of the people that own businesses don't have a good exit strategy. So when the time comes when they need their wealth in their business, which usually is about 80-85%, they can't get it out. So this gives you an overview of exec compensation, but I might add that many of the business owners are looking for methods in which they can shift their corporate cash flow into their wealth pocket and make it tax efficient. And by using executive compensation, it's very possible to take capital or cash flow through your corporation, get it to your personal wealth, and do it so that the cost is minimal. And I'd be more than happy to explain that to you in more detail if that is something of interest to you. Meanwhile, please feel free to check our blog. Feel free to contact me, email me. I'd be more than happy to answer any questions. Thank you.